Every financial system tells you collapse is unthinkable. But history shows something else. Systems don't collapse first. They manage the damage. And that delay is what makes the eventual cost so high. And welcome to Wheelixon, where history isn't just remembered, it's used to understand how money, power, and systems quietly break. Script starts. Every financial system faces the same dilemma sooner or later. Fix the problem now and accept pain, or delay the pain and preserve stability. History shows they almost always choose delay, not because collapse is inevitable, but because immediate collapse is politically, socially, and psychologically unacceptable. Delay feels safer. Delay buys time. Delay keeps confidence alive. And confidence is the foundation of every modern financial system. Financial systems do not function on truth alone. Belief that money will be accepted tomorrow. Belief that banks will open in the morning. Belief that obligations will be honored. Once belief cracks, systems freeze, credit disappears. So when problems appear, leaders don't ask, what is true? They ask, what keeps belief intact? That question explains centuries of financial behavior. When ancient states overspent, they didn't announce bankruptcy. They debased currency. When empires ran short on resources, they didn't stop expanding. They diluted obligations. When modern governments face unsustainable debt, they don't default loudly. They extend maturities, redefine targets, and inflate quietly. Each action delays collapse. None removes the underlying problem. Delay is not deception. It is strategy. And spreading pain is politically survivable. The Great Depression is often remembered as a sudden disaster. It wasn't. Throughout the 1920s, warning signs accumulated. Speculative leverage. But authorities chose reassurance. Corrections were healthy. When collapse finally came, it was far worse than early correction would have been. The same logic appeared decades later. Before the 2008 crisis, the housing market showed stress for years. Loan quality deteriorated, household debt surged, wages stagnated. But instead of confronting limits, the system innovated. Risk was sliced, packaged, and redistributed. Leverage increased under the assumption that liquidity would always exist. The system didn't fix the imbalance, it delayed it. When reality returned, the damage was systemic. This pattern repeats because delay serves multiple interests. Governments avoid political backlash. Banks avoid insolvency. Markets avoid panic. No one wants to be responsible for pulling the emergency brake. Delay also works because it hides causality. When pain is spread out, people adapt. Living standards erode slowly. Opportunities narrow quietly. Costs rise incrementally. There's no single moment to revolt against. History shows populations tolerate gradual loss far more than sudden shock. This is why inflation is one of the most powerful delay mechanisms. Inflation reduces real obligations without formal default. Debts remain payable. Promises remain intact on paper. But purchasing power declines. The system stays solvent. The public absorbs the cost. Collapse is avoided. Delay succeeds. Rather than admitting insolvency, systems extend timelines. Maturities are pushed forward. Interest is capitalized. Targets are redefined. The problem is not solved. It is postponed. The longer delay continues, the more the system relies on management instead of resolution. Interest rates become tools of stability, not signals. Liquidity becomes permanent, not temporary. Emergency measures become standard policy. What begins as exception becomes normal. History shows this transition clearly. At a certain point, systems stop trying to correct imbalance. They focus entirely on preventing collapse. Data becomes defensive. Narratives become reassuring. Transparency becomes selective. The system enters survival mode. This is when delay becomes dangerous. Because delaying adjustment increases dependence on intervention. Markets stop pricing risk honestly. Institutions assume support. Leverage rises further. The system becomes fragile beneath the surface, even as it appears stable. This is the paradox of delay. The longer collapse is postponed, the more severe the eventual correction becomes. History confirms this repeatedly. Short delays produce manageable crises. Long delays produce systemic shocks. Japan offers a clear example. After its asset bubble burst in the early 1990s, Japan chose stability over collapse. Banks were supported. Losses were spread over time. The result was not sudden collapse, but decades of stagnation. The system survived. Growth did not. Delay preserved order. It sacrificed momentum. Europe followed a similar path during sovereign debt crises. Rather than default, systems restructured endlessly. Deadlines extended. Collapse was avoided. Delay worked, but at the expense of dynamism. Delay also reshapes incentives. When institutions expect problems to be managed rather than resolved, behavior changes. Risk is tolerated, discipline weakens. Participants act as if time itself will solve structural issues. History shows time never does. The most misleading phase of delay is calm. Markets function. Confidence appears intact. This calm is often mistaken for success. But calm during imbalance is not stability. It is suspension. Truth is deferred. Pressure builds quietly. Eventually, delay reaches its limit. Reality reasserts itself, not because leaders choose honesty, but because constraints become unavoidable. Currency weakens. The system adjusts rapidly. When that moment arrives, narratives change. No one could have known. This was unpredictable. We did everything possible. But applied financial history shows otherwise. The decision to delay was visible long before the outcome. Understanding this pattern reframes how we see crises. They are not failures of prediction, they are failures of timing. Systems knew, they chose delay. This does not mean delay is always wrong. Immediate collapse can be catastrophic. Delay can prevent panic. It can buy time for adaptation. But delay without correction is not stability. It is borrowed time. Every system that delays must eventually pay interest. That interest is lower growth. When trust finally breaks, collapse follows. This is why financial systems rarely collapse suddenly. They erode until reality refuses to stretch further. Applied financial history teaches us to watch behavior, not headlines. Watch when problems are renamed. Watch when rules are bent. Watch when emergency tools become permanent. Those are signs of delay. Collapse is dramatic. Delay is subtle. And subtlety is why it works, until it doesn't. Financial systems prefer delay over collapse because delay preserves power. Collapse redistributes power violently. Delay controls distribution. That choice defines every era. If you understand this, you stop being surprised by outcomes. You stop asking, why did this happen? You start asking, how long was this delayed? That question reveals the truth far earlier than any forecast. Applied financial history is not pessimism, it is clarity. It recognizes that systems don't fail when panic begins. They fail when delay runs out. If you want to understand money and power beyond headlines, subscribe to Wheelixen.